All right. FOMC. 30 minutes ago, they raised the rates by 25 VPS, or the script came out. So now we're just waiting. Right now, I've got it pulled up on one of my screens here, but we're gonna keep the live stream on the S&P 500 and see the action. Personally, I think we close above 400, but it's all downside for the rest of the week. And so I think we'll close pretty green, but we're gonna reject and have more downside. Other than that, we've got 30 seconds until it starts. What's up?
Were you still holding your SPY calls?
Nope, sold it all. I'm out.
Ah,
I sold them yesterday at 398.20.
that's not bad.
Yeah.
You were in the positive, right?
Yeah, I made 60% on it. Here, they're live now. Fed is live. Welcome to the FOMC.
Is there a way to get that to play over the Discord?
Yes, but it won't be nice. I'll have to play it on my speakers in my room, and then it'll have to go through my mic.
Oh, I gotcha. Okay. Now also that you can find the feed on Twitter, but federalreserve.gov also has the live meeting.
Oh, here's Powell right now.
Good afternoon. Before discussing today's meeting, let me briefly address recent developments in the banking sector. In the past 2 weeks, serious difficulties at a small number of banks have emerged. History has shown that isolated banking problems, if left unaddressed, can undermine confidence in healthy banks and threaten the ability of the banking system as a whole to play its vital role in supporting the savings and credit needs of households and businesses. That is why, in response to these events, the Federal Reserve, working with the Treasury Department and the FDIC, took decisive actions to protect the U.S. economy and to strengthen public confidence in our banking system. These actions demonstrate that all depositors' savings and the banking system are safe. With the support of the Treasury, the Federal Reserve Board created the Bank Term Funding Program to ensure that banks that hold safe and liquid assets can, if needed, borrow reserves against those assets at par. This program, along with our long-standing discount window, is effectively meeting the unusual funding needs that some banks have faced and makes clear that ample liquidity in the system is available. Our banking system is sound and resilient with strong capital and liquidity. We will continue to closely monitor conditions in the banking system and are prepared to use all of our tools as needed to keep it safe and sound. In addition, we are committed to learning the lessons from this episode and to work to prevent events like this from happening again. Turning to the broader economy and monetary policy, inflation remains too high and the labor market continues to be very tight. My colleagues and I understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. The U.S. economy slowed significantly last year, with real GDP rising at a below-trend pace of 0.9%. Consumer spending appears to have picked up this quarter, although some of that strength may reflect the effects of swings in the weather across the turn of the year. In contrast, activity in the housing sector remains weak, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. Committee participants generally expect subdued growth to continue. As shown in our summary of economic projections, The median projection for real GDP growth stands at just 0.4% this year and 1.2% next year, well below the median estimate of the longer-run normal growth rate. And nearly all participants see the risks to GDP growth as weighted to the downside. Yet the labor market remains extremely tight. Job gains have picked up in recent months, with employment rising by an average of 351,000 jobs per month over the last 3 months. The unemployment rate remained low in February at 3.6%. The labor force participation rate has edged up in recent months, and wage growth has shown some signs of easing. However, with job vacancies still very high, labor demand substantially exceeds the supply of available workers. FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing upward pressures on wages and prices. The median unemployment rate projection in the SEP rises to 4.5% at the end of this year and 4.6% at the end of next year. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in January, total PCE prices rose 5.4%, excluding the volatile food and energy categories. Excluding those, core PCE prices rose 4.7%. In February, the 12-month change in the CPI came in at 6%, and the change in the core CPI was 5.5%. Inflation has moderated somewhat since the middle of last year, but the strength of these recent readings indicates that inflation pressures continue to run high. The median projection in the SEP for total PCE inflation is 3.3% for this year, 2.5% next year, and 2.1% in 2025. The process of getting inflation back down to 2% has a long way to go and is likely to be bumpy. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by a quarter percentage point, bringing the target range to 4.75% to 5%. And we are continuing the process of significantly reducing our securities holdings. Since our previous FOMC meeting, economic indicators have generally come in stronger than expected, demonstrating greater momentum in economic activity and inflation. We believe, however, that events in the banking system over the past 2 weeks are likely to result in tighter credit conditions for households and businesses, which would in turn affect economic outcomes. It is too soon to determine the extent of these effects, and therefore too soon to tell how monetary policy should respond. As a result, we no longer state that we anticipate that ongoing rate increases will be appropriate to quell inflation. Instead, we now anticipate that some additional policy firming may be appropriate. We will closely monitor incoming data and carefully assess the actual and expected effects of tighter credit conditions on economic activity, the labor market, and inflation. And our policy decisions will reflect that assessment. In our SEP, each FOMC participant wrote down an appropriate path for the federal funds rate based on what that participant judges to be the most likely scenario going forward. If the economy evolves as projected, the median participant projects that the appropriate level of the federal funds rate will be 5.1% at the end of this year, 4.3% at the end of 2024, and 3.1% at the end of 2025. These are little changed from our December projections, reflecting offsetting factors. These projections are not a committee decision or plan. If the economy does not evolve as projected, the path for policy will adjust as appropriate to foster our maximum employment and price stability goals. We will continue to make our decisions, meeting by meeting, based on the totality of the incoming data and their implications for the outlook for economic activity and inflation. We remain committed to bringing inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening in labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Thank you. Colby Smith with the Financial Times. How confident is the committee that the recent stress that we've seen and you've alluded to is contained at this point, and that deposit flight among mid-sized lenders in particular has ceased?
Thanks. So I guess our view is that the banking system is sound and it's resilient. It's got strong capital and liquidity. We took powerful actions with Treasury and the FDIC, which demonstrate that all depositors' savings are safe and that the banking system is safe. Deposit flows in the banking system have stabilized over the last week. And the last thing I'll say is that we're undertaking a thorough internal review that will identify where we can strengthen supervision and regulation.
Okay, just a quick follow-up. I mean, given all of the stress and the uncertainty that you've also alluded to in the statement, how seriously was a pause considered for this meeting?
So we did consider that in the days running up to the meeting, and you see the decision that we made, which I'll say a couple things about. First, it was supported by a very strong consensus, and I'll be happy to explain why. And really it is that the intermeeting data on inflation and the labor market came in stronger than expected, and really before the recent events, we were clearly on track to continue with ongoing rate hikes. In fact, as of a couple of weeks ago, it looked like we'd need to raise rates over the course of the year, more than we'd expected at the time of the SCP in December, the time of the December meeting. We are committed to restoring price stability, and all of the evidence says that the public has confidence that we will do so, that we'll bring inflation down to 2% over time. It is important that we sustain that confidence with our actions as well as our words. So we also assess, as I mentioned, that the events of the last 2 weeks are likely to result in some tightening in credit conditions for households and businesses, and thereby weigh on demand, on the labor market, and on inflation. Such a tightening in financial conditions would work in the same direction as rate tightening. In principle, as a matter of fact, you can think of it as being the equivalent of a rate hike, or perhaps more than that. Of course, it's not possible to make that assessment today with any precision whatsoever.
Dude,
so
all he's doing
was
is
to move ahead
reading
with a 25 basis point hike, and to change our guidance, as I mentioned, from ongoing hikes to some additional hikes, maybe some policy firming may be appropriate. So going forward,
Policy firming may be appropriate.
As I mentioned, in assessing the need for further hikes, we'll be focused as always on the incoming
sounds like
data
all they
and the
did was
evolving outlook,
isolate the
and
banking
in particular
incident
on our
instead of
assessment of
addressing
the
it.
actual and expected effects of credit tightening.
Which, like I said earlier when we were texting, the meeting was already in place,
explain,
so I really didn't expect to
the
hear
difference
too much
between
about
ongoing rate increases
the banking
and
situation.
firming. Does
Because
firming
it takes
imply a
everything
rate
they
increase
have
per se,
to
or
just
could
figure
hold on,
out what they're going to do with their
firm
rates.
increasing rates?
Just firming employer rate.
No, I think it's meant to refer to our policy rate. Really, I would focus on the words may and some, as opposed to ongoing. So we clearly what we were doing there was taking on board trying to reflect the uncertainty about what will happen. I mean, it's possible that this will turn out to have very modest effects. These events will turn out to be very, very modest effects on the economy, in which case, and inflation will continue to be strong, in which case, the path might look different. It's also possible that this potential tightening will contribute significant tightening in credit conditions over time, and in principle, if that means that monetary policy may have less work to do. We simply don't know.
So he just basically
Concerns
said
that the hike he
that
did today could further exacerbate the
they're
problem in the
okay
banks.
with going back and forth,
No, I
pausing
mean, with our
and,
monetary
and
policy,
raising,
we're
pausing
really
and
focused
raising.
on macroeconomic outcomes. In particular, we're focused on this potential
I think
credit
25
tightening
basis
and
points is too low.
what
They
can that
should have raised it
produce in
by
the way of tighter credit
0.50.
conditions. I think when we think about the situation in the banks, we're focused on our financial stability tools, in particular our lending facilities, the debt, the discount window, and also the new facility.
Nick Timmeros of the Wall Street Journal. Chair Powell, in your testimony 2 weeks ago, you had indicated you thought the terminal rate would be higher. Obviously, that was before the stress in the banking sector. And I realize there's a lot of uncertainty, but can you explain at all to what extent your forecasts or those of your colleagues or those of the board staff incorporated today a material tightening of credit availability because of the stress in the banking sector, or are you waiting to see it in the data before you incorporate that potential tightening into your forecasts?
So, we've just come from an FOMC meeting, and, the people who write the minutes will be very carefully counting, but I'll tell you what I heard. What I heard was a significant number of people saying that they anticipated there would be some tightening of credit conditions, and that would really have the same effects as our policies do, and that therefore they were including that in their assessment, and that if that turned out not to be the case, that in principle you'd need more rate hikes. So some people did reflect that in their SEP forecasts. I think there may also just have been, remember, this is 12 days ago. We're trying to assess something that just is so recent, and it's people, it's very difficult. There's so much uncertainty. So December was a good place to start, and we wound up with very similar outcomes for December. And in a way, the data in the first part, the first 5 weeks of the intermeeting period, pointed to stronger inflation and stronger labor market. So that pointed to higher rates, and then this latter part, kind of the possibility of credit conditions tightening, really offset that effectively.
To follow up, have you considered at all whether your primary tool, the funds rate, is going to be enough to sustain the kind of tighter financial conditions that you believe will be necessary without doing significant damage to the banking sector? Have you, for example, considered changing reserve requirements, selling assets out of the system, open market account, as a way to better achieve tighter financial conditions that don't accelerate deposit erosion, for example, from banks?
We know that we have other tools in effect, but no, we think our monetary policy tool works, and we think, many banks, our rate hikes were well telegraphed to the market, and many banks have managed to handle them.
Hi, Victoria Guida with Politico. I wanted to ask, you, along with the FDIC and the Treasury, the Fed Board decided to invoke the systemic risk exception to allow uninsured depositors to be protected at these two banks. And I was just wondering if you could speak to why that decision was made. Was it purely a confidence issue, or was there a concern that there would be some sort of economic contagion or financial contagion from the failure of these banks?
The issue was really not about those specific banks, but about the risk of a contagion to other banks and to the financial markets more broadly. That was the issue.
Okay, and then can you also, just to follow up, can you speak to the role that you will be playing in the Fed's internal investigation on its supervision and regulation? So
Vice Chair Barr is of course leading that review, and he's responsible for it in his capacity as Vice Chair for Supervision. I realized, right away that there was going to be a need for a review. I mean, the question we were all asking ourselves over that first weekend was, how did this happen? And so what we did was early Monday morning we sat down and said, let's do this, and he was obviously going to lead it in his capacity. So I don't, my role was to announce it, and I get briefed on it, but I'm not involved in the work of it.
Hi, Chair Powell. Howard Schneider from Reuters. So I want to go back to your February press conference. You mentioned the word disinflation, I believe, 9 or 10 times, a process that you felt was, I forget the word you used, but gratefully underway or something like that. Is disinflation still occurring in the U.S. today?
Yes, I mean, what actually happened, Howard, was I got the question 12 times. So maybe it's a feature, not a bug. But yeah, absolutely absolutely the same. The story is intact. So it's really three parts, right? Goods inflation's been coming down now for 6 months. It's proceeding more slowly than we would have liked, but it's certainly proceeding. Housing services is really a matter of time passing. We continue to see the new leases being signed at much lower levels of inflation. So that's 44% of the core PCE index, where you've got a story that's ongoing. Where we didn't have in February, and we still don't have now, is a sign of progress in the non-housing services sector, and that is that's just something that will have to come through softening demand and perhaps some softening in labor market conditions. We don't see that yet, and that's of course 56% of the index. So the story is pretty much the same. I will say that the inflation data that we got, to your point, really pointed to stronger inflation.
If I could follow up on that, I was curious why you don't see more coming from the credit crunch, because it seems to me that's something that you'd actually welcome to a degree and expect. And are you not seeing more coming from that because you don't know, or because you just don't want to have another round of wishful thinking?
So it's really just a question of not knowing at this point. There's a great deal of literature on the connection between tighter credit conditions, economic activity, hiring, and inflation. Very large body of literature. The question is, how significant will this credit tightening be, and how sustained will it be? That's the issue. And we don't really see it yet. It's so people are making estimates, people are publishing estimates, and it's very kind of rule of thumb guesswork almost at this point. But we think it's potentially quite real, and that argues for being alert as we go forward, as we think about further rate hikes. For us, we'll be paying attention to the actual and expected effects from that.
Gina. Hi, Chair Powell. Gina Smilik from the New York Times. Thank you for taking our questions. I wonder if you could talk a little bit, I know that you've got your internal review coming, but I wonder if you could talk a little bit about what you think happened with oversight at Silicon Valley Bank, and whether this suggests that something about regulation and supervision needs to actually change going forward. And I wonder, how can the American people have confidence that there aren't other weaknesses out there in the banking system, given that this one got missed, as you noted?
So let me say what I think happened, and then I'll come to the questions around supervision. So at a basic level, Silicon Valley Bank management failed badly. They grew the bank very quickly. They exposed the bank to significant liquidity risk and interest rate risk, didn't hedge that risk. We now know that supervisors saw these risks and intervened. We know that the public saw all this. We know that SVB experienced an unprecedentedly rapid and massive bank run. So this is a very large group of connected depositors, concentrated group of connected depositors, in a very, very fast run, faster than the historical record would suggest. So for us, for our part, we're doing a review of supervision and regulation. My only interest is that we identify what went wrong here. How did this happen is the question. What went wrong? Try to find that. We will find that. And then make an assessment of what are the right policies to put in place so that it doesn't happen again, and then implement those policies. It would be inappropriate for me at this stage to offer my views on what the answers might be. I simply can't do that. Vice Chair Barr is leading this, and I think he's testifying next week. So, but that will be up to him. So that's really where it is. The review is going to be thorough and transparent. It is clear, to your last question, it's clear that we do need to strengthen supervision and regulation. And I assume that there will be recommendations coming out of the report, and I plan on supporting them and supporting their implementation.
Sorry, and the final point, can we feel confident that these weaknesses don't exist elsewhere, given that they got missed at this bank?
These are not weaknesses that are at all broadly through the banking system. This was a bank that was an outlier in terms of both its percentage of uninsured deposits and in terms of its holdings of duration risk. And again, supervisors did get in there, and they were, as you know, obviously, they were on this issue, but nonetheless, this still happened, and so that's really the nature of the of the review, is to discover that.
Michael McKee from Bloomberg Radio and Television. You've been very consistent in saying that the Fed would be raising interest rates and then holding them there for quite some time. Following today's decision, the markets have now priced in one more increase in May, and then every meeting the rest of this year, they're pricing in rate cuts. Are they getting this totally wrong from the Fed, or is there something different about the way you're looking at it, given that you're now thinking that moves might be appropriate as opposed to ongoing?
So we published an SEP today, as you will have seen, and it shows that basically participants expect relatively slow growth, a gradual rebalancing of supply and demand in the labor market, with inflation moving down gradually.
He's a genius.
In that most likely case, if that happens, participants don't see rate cuts this year. They just don't. I would just say, as always, the path of the economy is uncertain, and policy is going to reflect what actually happens rather than what we
you've been raising rates already, and it
That's not our
hasn't helped
baseline
inflation.
expectation.
Do you really
If I
believe
could
it's
follow
going
up
to
and ask,
continue to help?
as you look forward into the rest of the year here, are you saying that what you see and the 5.1% basically consensus is based on it will be sufficiently restrictive, or is it leavened by the idea of you don't know what's going to happen? In other words, what should people think about in terms of how the Fed thinks about how far it is from the terminal?
It's going to depend. Remember, we're looking, for purposes of our monetary policy tool, we're looking at what's happening among the banks and asking, is there going to be some tightening in credit conditions? And then we're thinking about that as effectively doing the same thing that rate hikes do. So in a way, that substitutes for rate hikes. So the key is we have to have policies got to be tight enough to bring inflation down to 2% over time. It doesn't all have to come from rate hikes. It can come from tighter credit conditions. So that we're looking at, and it's highly uncertain how long the situation will be sustained or how significant any of those effects would be. So we're just going to have to watch. In the meantime, and obviously at the end of the day, we will do enough to bring inflation down to 2%. No one should doubt that.
Go to Rachel Siegel.
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thank you for taking our questions. I know we've talked a bit about how Silicon Valley Bank was unique to a certain sector of the economy, but there's also growing concern that there are financial stability risks from the commercial real estate market.
Everything's
and
about
loans
the
that will begin
banks.
to roll
You know
over
that
later
first
this
comp,
year and
like
next,
when it
and
got
that
released
smaller
at
regional banks also disproportionately
30
hold
minutes
those
before
loans.
to talk,
Is there a
nothing
risk
was
that
about
could
the
mimic
banks,
the
but
kind
now
of
everything is
what
about
we saw
the banks.
with SVB to banks that disproportionately are focused in commercial real estate?
I think they
So
realize that.
well aware
people are
of
more
the
concerned
concentrations
about
people have in
banking
commercial real
crash
estate. I
than
really
they are
don't think
about
it's
inflation.
comparable to this.
know, right.
The banking system is strong, it is sound, it is resilient, it's well capitalized, and I really don't see that as at all analogous to this.
One other question. Would you be open to an independent investigation separate from the Fed's probe?
I welcome. It's 100% certainty that there will be independent investigations and outside investigations and all that. So we welcome, when a bank fails, there are investigations, and of course, we welcome that.
Edward.
Thank you, Mr. Chairman. Edward Lawrence from Fox Business. Inflation has been rather sticky, so do you need help from the fiscal side to get inflation down faster?
You think SVB
We don't assume that. We don't give advice to the
failed?
fiscal authorities, and we assume that we take fiscal policy as it comes to our front door, stick it in our model along with a million other things, and we have responsibility for price stability. The Federal Reserve has responsibility for that, and nothing is going to change that. So we will get inflation down to 2% in time.
And if I could follow on that, but they're working, the spending that's happened is working against what you are doing, right? So it's prolonging inflation?
You know, if you have to look at the impulse from spending, because spending was, of course, tremendously high during the pandemic, and then as the pandemic programs rolled off, spending actually came down. So the sort of fiscal impulse is actually not what's driving inflation right now. It was at the beginning, perhaps, part of what was driving inflation, but that's not really the story now.
Let's go to Neil Irwin.
Hi, Chair Powell. Neil Irwin with Axios. Two questions about aspects of the government's response on Silicon Valley Bank 2 weekends ago. First, why is this new bank funding facility done under Emergency 13.3 authority as opposed to expansion of the discount window, changing the terms of the discount window that's been around a long time? And second, can you discuss the Fed's role in the FDIC guarantee of uninsured depositors and why there's $143 billion on your balance sheet last week supporting that deposit guarantee?
Sure. So 13.3 seemed like the right, we have a little more flexibility under Section 13.3. We've done quite a lot under the discount window as well. We needed to do a special facility that was designed a certain way, so we did it under 13.3. Really no magic to that. It's only available in unusual and exigent circumstances, and it has to meet certain requirements, but it seemed to be the right place. So with the FDIC, we're lending to the, in effect, we're lending to the bridge bank. So that's where the funds came from, and it's a loan that's 100% guaranteed by the FDIC, so there's no risk in it for us.
Chris Rugaber.
Thank you, Chris Rugaber at Associated Press. The SEP suggests one more rate hike, as does the change in the language in the statement, in which suggests that you're perhaps nearing the end of a cycle of rate hikes. Do you feel, though, that if inflation remains high, you'll be able to resume additional hikes as needed, or have you somewhat tied your hands here with these signals about rate hikes coming to an end? Thank you.
Absolutely not. No, if we need to raise rates higher, we will. I think for now, though, as I've mentioned, we see the likelihood of credit tightening. We know that can have an effect on the macroeconomy, on demand, on labor market, on inflation, and we're going to be watching to see what that is. And we'll also be watching what's happening with inflation and in the labor market. So we'll be watching all those things, and of course we will eventually get to tight enough policy to bring inflation down to 2%. We'll find ourselves at that place.
Hi, Chair Powell. Thanks for taking the question. Kyle Campbell with American Banker. I have a couple questions about the balance sheet. First of all, I'm curious at what point the financial supports that the Fed is extending through the discount window and through its enhanced lending facility might be at odds with the objective of reducing the balance sheet. And I'm also curious what your thoughts are on not just the availability of reserves, but the distribution of them throughout the banking system, and at what point you might be concerned about it being scarce for certain banks.
So people think of QE and QT in different ways, so let me be clear about how I'm thinking about these recent developments. So the recent liquidity provision that has increased the size of our balance sheet, but the intent and the effects of it are very different from when we expand our balance sheet through purchases of longer-term securities. Large-scale purchases of long-term securities are really meant to alter the stance of policy by pushing up the price and down the rates, longer-term rates, which supports demand through channels we understand fairly well. The balance sheet expansion is really temporary lending to banks to meet those special liquidity demands created by the recent tensions. It's not intended to directly alter the stance of monetary policy. We do believe that it's working. It's having its intended effect of bolstering confidence in the banking system and thereby forestalling what might otherwise have been an abrupt and outsized tightening in financial conditions. So that's working. In terms of the distribution of reserves, we don't see ourselves as running into reserve shortages. We think that our program of allowing our balance sheet to run off predictably and passively is working. And of course, we're always prepared to change that if that changes, but we don't see any evidence that that's changed.
Hi, Chair. Katerina Saraiva with Bloomberg News. The minutes of the January-February meeting, the last meeting, indicate that you discussed the possibility of runs on non-bank financial institutions and the impact of large unrealized losses on bank portfolios. Can you talk a little bit more about that discussion, kind of what was talked about in light of that? And then why didn't the Fed do anything about that at that point to ultimately prevent, what happened this month?
I mean, to be honest, I don't recall the specifics of that. It's quite an interesting 7 weeks, but I will tell you though that there have been presentations about interest rate risk. I mean, it's been in all the newspapers. It's not a surprise that there are institutions that have had unhedged long positions in long duration securities that have lost value as longer term rates have gone up due to our rate increases. So that's not a surprise. I think, as you know, as it is now on the public record, the supervisory team was apparently very much engaged with the bank repeatedly and was escalating, but nonetheless what happened. And so that's really the purpose of one way to think about the review that Vice Chair Barr is conducting, is to try to understand how that happened and try to understand how we can do better and what policies we need to change. I mean, one thing is the speed of I'll come back to that, the speed of the run. It's very different from what we've seen in the past, and it does kind of suggest that there's a need for possible regulatory and supervisory changes, just because supervision and regulation need to keep up with what's happening in the world.
Can you confirm whether or not the board knew about these escalations by the examiners in San Francisco?
I will have to come back to you on that. Yeah, I don't know.
Simon Urbanovich with The Economist. Thank you very much. Chair Powell, you've stated twice today that all depositors' savings in the banking system are safe. Are you saying that de facto deposit insurance covers all savings? Shouldn't Congress have a say in that? And just by way of example, if a bank with less than $1 billion in assets failed, are you promising to bail out all of its depositors? Thanks.
Well, I'm not saying anything more than I'm saying. So, but what I'm saying is you've seen that we have the tools to protect depositors when there's a threat of serious harm to the economy or to the financial system, and we're prepared to use those tools. And I think depositors should assume that their deposits are safe.
Go to Greg Robb.
Thank you, Chair Powell. Greg Robb from MarketWatch. I was wondering if you could give us a little bit more color. You gave just a little bit of color. You said during the first week of the Silicon Valley weekend, you said the question you guys asked was, how did this happen when you saw Silicon Valley Bank? So I was wondering if you could go to the Credit Suisse merger. I mean, wasn't that the big gorilla in the room? Didn't you breathe a sigh of relief when that merger happened? Thanks.
Sure. So, that was really the Swiss government. We, of course, were following it over the course of the weekend, and we were engaged with their authorities in the way that you would expect, all the ways that you would expect. It seems to have been a positive outcome in the sense that the transaction was agreed to, and it has been, the markets have accepted it, and it seems to have gone well, and I think there was a concern that it might not go well. So coming into the middle of this week, yes, I would say that has gone well so far.
Nicole.
Hi, thank you, Chair Powell. Nicole Goodkind with CNN Business. In the summary of economic projections, the FOMC sees the unemployment rate increasing to 4.5% this year. I'm wondering how you anticipate preventing this from snowballing while using the admittedly blunt tools at your disposal.
So that's an estimate of what will happen as demand slows and as conditions soften in the labor market. And it's a highly uncertain estimate. And I mean, there's really, we have to bring inflation down to 2%. The costs of bringing it down, there are real costs to bring it down to 2%, but the costs of failing are much higher. And if you read your history, as I'm sure you have, you can see that if the central bank doesn't get inflation back in place, make sure that inflation expectations remain anchored, you can have a long series of years where inflation is high and volatile, and it's hard to invest capital. It's hard for an economy to perform well, and we're looking to avoid that, and and to get back to where we need to be, back to where we were for a quarter century, and get there as quickly as we can.
But I guess the question is, historically, it's hard to.
Mr. Mike, please.
Yes, sir. Historically, it's been hard to contain unemployment, and the question is, do you worry about some sort of snowball effect, and how do you factor that into your projections and your
Well,
thoughts?
it depends on whether so recessions tend to be nonlinear, and so they're very hard to model. You know, the models all work in a kind of linear way. If you have more of this, you get more of that. But when a recession happens, the reactions tend to be nonlinear, and that's so we don't know whether that'll happen this time. We don't know. If so, we don't know how significant it will be. And so, you know, we're very focused on getting inflation down.
Right now, I'm just waiting. I want to see a pushback up to 400,
benefit the people we
and then I'm
serve.
going to grab SPY
That's how
puts
we
for
can
a
have a
swing.
long, you know, we've had very
we
strong
just seen
labor markets
validating volume
through
that
these
says
long
that
expansions that we've had.
that
4 of the
now
5
there really
longest, or
is
3 of the
an
4 longest
increasing amount of
expansions in
selling.
U.S. history have been
So
really
I'm
since the high inflation
I
period.
know what
And
the
reason
market
was
wants to do now, so I'm
Inflation
gonna wait for a
wasn't
pullback
forcing
up
the central bank
400.
to come in and stop an incipient
So,
or
let me
you know,
ask you,
an expansion. You can
why
have
do
very,
you
very
think
long
that
expansions without
that we're having so
high
much more
inflation, and we
selling
had several of those,
than
and
we are
they're
with
very
buying
good for people.
after
You see late in
that
expansion,
press release?
you see low unemployment, you see the benefits of wages going to people at the lower
I don't
end
know.
of
I
the
think
wage
everybody
spectrum.
wanted to
It's
cut.
just a place that we should try to get back
Everybody wanted to pause.
Profit taken.
Yeah, it's probably that. It's probably a buy the rumor, sell the news scenario. Everyone was buying because they think the Fed was going to pause or cut.
The past
and
2 weeks,
you know,
do you still see
so I'm going to wait for.
I mean, that's a valid point.
Yeah.
Everything that I've read
You know,
had
it's
them
too early
on
to say
the,
really
the
whether
sides of rate cuts today, and I'm like,
whether these
there's no
events
way
have had
that's going
much
to
of an
happen.
effect. It's hard for me to see how they would have.
I wish we would just rip the
possibility,
Band-Aid
but
off,
I guess I would
raise
just say
the rates
it's
to
too
what we
early to
need
say
them
whether
to
there
be
really
at
have been
in order to combat the
changes in that,
inflation.
you know.
And
The
then
question
from
will be
there,
how long this period is sustained.
you know, we'll just take the hit now instead of, because he's on a 3-year projected plan.
The likely
you know, to get inflation under control.
declines in
I wish they would just
tightening
do it.
credit standards,
Add the
credit
other
availability. So we'll just have
level
to
would be
see. I do still think
1.25
though
or
that there's a
125 basis
pathway
points and
to
just
that.
get
I
it
think
over
that
with.
pathway still exists, and
Yeah.
you know, we're certainly trying to find it.
You know, that's just my opinion, but
Hi, Chair Powell, Nancy Marshall-Genzer with Marketplace. Just wondering how many financial
I
institutions
was
have been
thinking
issuing
back
matters
to the
requiring
bank
attention or matters
crash in
requiring
2008.
immediate attention
Uh-huh.
citations at this point?
I don't
How
think
many?
that
I don't know.
really
But those are
affected-
serious. Those are serious regulatory, in particular immediate attention. That's and I guess there were
You know,
6
like
of them.
they're
So-
using it as a comparison.
And
but
getting to the
I don't
seriousness of
remember
it, how are you
not
going
being able
to
to afford to
ensure
live
that
or being
banks
pissed about,
comply
you know,
with
interest
these
rates and
citations,
things like
take them
that.
seriously? How will you
None of
enforce
that
them?
sounded
That is a
familiar. You
great
were probably
question
too
and is
young
right in the heart of what the
I was.
to feel the
the
effects
review
of it.
will be doing under Vice Chair Barr's leadership. So that's
So I'm just
I
like,
think
let's
that's
just go
where
ahead and get it over
that's
with
what you
and
think
be
about.
done.
You know, what can we do to make sure?
But
again, that's
a
not
side
for me
note
to
on
answer.
that, the Silicon
today.
Valley Bank.
Specific thoughts on that.
Their
Well, see if I did, I wouldn't
executive
share them because
took out
I
$219
really,
million
you know,
worth
this,
of
this
loans
review's going on
right before that,
and,
the month leading
you know,
up to the
wanna,
crash.
I want nothing other than us to
Yeah.
find
So
out what happened
if
and
the
why.
bank goes under, they don't
figure
have
out
to
what we
repay
can do
those
to do
loans
better,
back.
and then
It
implement
was
those
actually
changes.
pretty
That's all I want.
ingenious.
It's for me to
But
be
I would think they're
giving
going to
you
have
my
to send people to
half-formed
jail
or
over
partially
that,
informed thoughts.
that collapse.
You know,
Dang.
it just isn't appropriate.
Because
There's a real
instead of
serious
it being
review going on
accidental or
with people
blaming it on
from
the
all over the
economy
Federal
and
Reserve System who are not
COVID,
connected to this. You know,
I think
to
what
this,
it comes down to
work,
is those
not
bankers
connected
were
to this bank,
misusing
and
the bank and its funds,
Vice Chair Barr's
and that's what
leadership,
caused
and
the
I'm
global
confident
collapse
that it
of
will
it.
produce a satisfactory result.
See, what's so concerning to me, this is what's so concerning. This
Chair
is
Powell,
why I
Jennifer
think
Schonberger with Yahoo Finance.
the market is actually
Curious,
going to
how
be
do you view financial
oversold by the
conditions right
end
now?
of March.
If credit becomes expensive enough,
let's talk
choking off
after
growth,
because I
as you
kind of
said
can't
you're watching
concentrate.
for,
I'm like
would that
I'm trying to listen
situation
and talk. So
warrant
just
a rate
let's
cut?
let's
What
finish this and
situation
we'll
would
talk.
warrant a rate cut?
Yeah,
And
no,
have
you're
the
good.
bank failures prompted any discussion around
you.
changing the implementation of the balance sheet runoff? Thank you.
So we haven't really talked about changing the balance sheet implementation. That's not something we've discussed yet. As I mentioned, we're always willing to change that if we conclude that it's appropriate, but we're really not seeing any signs there. Sorry, then the question before that was, just give me a...
Curious how you view financial conditions now, and if
Yeah,
credit were
okay.
to tighten enough, if that would prompt a rate cut.
So, financial conditions seem to have tightened, and probably by more than the traditional indexes say, because the traditional indexes are focused a lot on rates and equities, and they don't necessarily capture lending conditions. So we think that, though. So there are other measures which if they're focused on, bank lending conditions and things like that, they show some more tightening. The question for us, though, is how significant will that be, and how, what will be the extent of it, and what will be the duration of it? And then, once you know that, there's a fair amount of research about how that with broad uncertainty bands, how that works its way into the economy over what period of time. And so, so we'll be looking to see the first part of that, like how serious is this, and how does it look like it's going to be sustained? And if it is, it could easily have a significant macroeconomic effect, and we would factor that into our policy decisions. I mentioned with rate cuts, rate cuts are not in our base case, so that's all I have to say. So,
Thank you.
thank you very much.
I guess that's it. So what I was gonna say was, this was definitely not your normal FOMC. And obviously, right, but usually they're talking more questions about not crisis events, but obviously, but it was so unusual because almost every question was about the banking crisis. Almost every single question. So, but one thing that I feel was really important that Jay Powell said was that, anyways, the vibe I got from what he said, I don't remember exactly what he said, but it was something about how they're either like they're monitoring it and they will take action accordingly. That's not quoted. That's just what I got from it. So we could see them pause, then go back to raising 25 BPS, and then the information comes back strong again. Then they go to 50, and then they go back to 25, then they pause and they cut. So I think they're in that zone now where they're like, they're testing here and testing there. So whether or not that's good, because it seems like right now we have a Fed that doesn't know, and they're a little bit uneasy about what just happened the past 2 weeks. So to me, that's scary, because if the Fed is giving indicators that we have to raise anyways, even though everything that they were telling me just now says that, hey, market conditions were tightening, blah, 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 everything was good, blah, 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 everything was good. In fact, even even what we predict that how the economy is going to act with rates and all that, or how the economy is going to get affected with this crisis, let's still go ahead and do it 25 BPS. That's scary to me. I'd think for everybody to understand that it's okay is to say, you know what, it's the labor, whatever is tightened. I don't know what really is going on, but it's, the market's tightened, or the economy's tightened. So let's pause now, or we'll just pause for this month, or say we'll pause with the expectation of doing a rate hike next month, because what happened with the banking, everything is basically a rate hike. Why didn't they do that now? Why did they? That's just my opinion. Why didn't they do that now? Why are they waiting to say, oh, we'll wait to see it? We've already seen. So now it's very possible they could have made it worse by trying to ease fears and do all that, because my theory was that we have over tightened because everything was lagging. But the Fed doesn't. Do you really think the Fed care? I mean, they just want to get the interest rate or they want to get inflation back down to 2%, but they can't destroy the economy by doing that. So I was very concerned when they said they were going to be wishy-washy. They didn't say that, but they said it to me. Or the way that I interpret it was, we're going to be wishy-washy for a little bit. We might pause, we might raise, we might cut, we might this, we might that. It's all going to depend on the numbers that come out. That tells me that they don't even know. They can't even predict what's going to happen right now, which they should. They should be able to predict it. But they
Right.
can't even predict it right now, which is scary to me.
See, and I got something very similar to what you just said. They don't know what the future holds. Now it's just trial and error.
Yeah.
So they may add basis points, they may cut points, but they're trying to convince us that tightening up the credit on lenders is going to prevent another bank system from failing.
Yeah.
And it's like, but we did that in 2008, and did the bank survive? Yes, but they had bailout money from the government back then,
Right.
which Biden has stated that he's not going to do that type of bailout this time, which I totally agree with it. But I think you're right. They're more or less saying we're just throwing darts at a board with blindfolds on, and we'll see how the economy reacts to it, and then we'll take it from there.
Well, really, that's what they're doing, because we just had a pandemic. They had to print money. They had to inflate the economy. Now they have to deflate the economy while trying to fight inflation. Or maybe, I guess they already deflated the economy. I don't know what happened in COVID, but that's more or less the point. The point is that COVID was an unexpected crisis. They had to take unexpected measures that hasn't been taken before. So whether or not they knew what to do could have had a very big impact on what's happening now. Because if they took the wrong moves, we're seeing side effects, and now they're trying to manage the side effects.
Yeah, I agree with that. I think that's a very good way to put that.
But
And it wasn't too long ago where Jay Powell was saying we won't need to raise rates. There's no reason. Inflation is totally under control, under our thumb. And he preached that for months. And then one day he just came out and said we had no choice. We had to raise rates based off of everything that we're seeing. So you would think they could use previous history as an example of what to do and what not to do.
Right.
But I think you're right. It sounds like they have no clue. That'd be like putting me or you sitting at, in the Fed chair and us being like, well, I don't have any education on this and I don't really know what I'm doing, but what happens if we do this? Oh, bad idea. What if we do this? Oh, that seemed to work. But so pretty much, I think it's still at a gamble, and the fact that they think they're going to get inflation finished by the end of 2025, I don't think that's a realistic goal. I think it sounds great, but I don't think it's realistic. That's like, them just adding 25 basis points, and then next month they're not going to do anything. But then in May, they're probably going to add another 25 if they stay on the same track of what they've been doing.
Mm-hmm.
And then after that, they claim that's all the rate hikes. We're going to start deducting interest or basis points off of the prime rate. And it's like, but how do you know? We're talking 60, 75 days away, and you're already planning this out, which is good to have a plan. However, what you're doing isn't working for inflation right now. So how could you possibly convince us as American citizens that we're going to be at a point in 60 to 75 days where we can start backing the rate down?
I'm gonna take.
You know what I
right
mean?
now. I'm actually gonna buy puts right now. I'm gonna get 370s. I'm gonna get 370s for like April 28th. I really think the market's gonna shoot down after that. But it's just I don't like that they're uncertain. I don't like that. I think, and I actually really don't like that they said the indices are almost lagging. He said that at the end. He didn't say lagging, but he said it's not very accurate. I forget what word he really uses, but that's what I got. Is that he said they're not very accurate. He said some things that are monitoring the real levels are more accurate.
See, and I can agree with that, only because the indices only work after it's already happened. Like we sit there and we're like, okay, I'm going to do puts, I'm going to do calls. Oh, look, the market's going to be bad today. For example, it's going to be a red day. How did we know that? Because the indices opened up red, and it's past history. There's no way of being able to predict it going into the future. So
Right.
it's just one of those. I agree. I don't think the indices are very accurate, but I'll tell you what, if you only traded one stock ever in the world, it would be SPY. And you could do it over and over and over and over again.
Yeah.
Because the indices are a direct reflection on what the majority of the stocks are doing in that sector.
Right.
So it's not really, when I put the futures out there, it's not really me saying, okay, this is how today's going to be. It's saying this is how it was, and do you think it's going to stay on the same path, or do you think it's going to turn green?
I mean, in the market's almost telling me. I mean, by reading this volume, it's telling me the higher the prices are going, the less that people are buying. So this isn't too cheap right now.
No, not at all, man. And
so I really think we have downside for sure. That's what I think.
I think we talked about this on Monday. People aren't buying the higher it goes is because retail traders have taken over the market. Unsuspecting and a surprise to Wall Street. However, the average Joe isn't going to spend $400 on one SPY share so that you can make $2 or $3. So I think that the higher the prices are, the less people will dabble in it.
Well, you think? These are real companies that make money. So I would think so, because people are wanting to buy the dip. But if we have pivoted, which 350 was around like the pivot. If we are not going to get there, we should have been seeing increasing volume the higher we went, but nothing has really said that. It's the only part that showed me there was increasing volume the higher we went was from January to February. From January to February, we saw the slightest bit of buyers saying, you know what, this actually is too cheap. But that doesn't mean that there's continuation. It has to continue. It just means that for that move, buyers were saying, this is too cheap. I'm actually going to keep buying more as it's going up. Right now, buyers are saying this is not too cheap. In fact, I'm going to buy less the higher that it goes. So it's very, very plausible to me that we could at least double bottom at 380, see 380 again, which is, or at least, at very least 390. I mean, we'll go to 390 again, because that's the highest volume price since the beginning of our quote-unquote recession is 390. And from there, I think it's even more plausible that we see 380, because really, I think from this move that we just saw, how we saw this bullish move into the FOMC, but people are buying less and less as prices are going higher. And in fact, we have that gap from, I think, Friday to Monday, or what was it, 2 days ago, some of that. Was today Wednesday? Yeah. So the
Yes.
gap from Monday to Tuesday, we had that gap from Monday to Tuesday. I think we feel that within the next few days as well. So I took a starter, and I'll be adding. You know, if we go higher, I'll add into that, and then I'll max out. You know, and wait for to start averaging up, if once I'm right. But I don't know. I didn't like that press conference, or I didn't like that FOMC. I think that Powell almost got irritated at the end from all the bank questions. It's kind of what it seemed like to
Yes.
me.
I'll
He
tell
was
you
like,
what, some of
"Damn
those
it."
reporters are awesome.
I agree. But I think the Fed sometimes uses like the FOMC to gauge the sentiment, right? Probably had a very negative sentiment for them.
Right.
Like, how many people are going to ask about banks? Well, all of them. Literally, like, it was probably like 90% of them. 9 out of 10 reporters.
Yeah, 'cause, hey, they've already covered the interest rate. So all that's left is what's going on with these banks.
Yeah. I mean, but other than that, I'm pretty bearish for the next few weeks probably. I just got some farther out option contracts just, to save me some premium in the case we move sideways. But
Man, I'm still sitting on my IWM puts that I bought the other day.
oh
And
yeah?
even though the SPY was green, the puts still went up in price.
Oh, Russell 2000. Yeah, dude, that's ranging good. When did you buy those?
What day was it? It was only a what day was that? Hold on. 320. So Monday.
Really?
Yes. Yeah,
Oh,
it's
okay.
crazy how much they're actually up. And wait till the market swings to bearish, like you're saying, like when the indices start getting there with the SPY and stuff. I think you're going to see that this is going to be an easy like 500 to 1,000%er. And I put it out far enough. Oh, I missed the date. I said 429. It was 428 is the expiration date. But it's out far enough where either A, you're too far out and you're not going to make any money because the premium adjusts, between now and 6 weeks, or B, it's perfect and we're going to make 500 to 1,000% on it once the market swings the other way.
Dude, no, you're right. I'm looking at the volume right now, and it is saying that. It's saying that the higher prices go, the less they're buying. Even in this little range that it's in right now, since the 10th till now,
Yeah.
this little consolidation, it's the higher. It's basically, I mean, market makers they're just testing. They're trying to see if there's any supply or any demand. They're trying to see that if they push the market up and raise prices, how many people are going to buy? There's nobody. So it's going to go lower because they have to flush out all the sellers before they
Yeah,
before that happens.
that's a very good way of looking at that. And what's so funny is 3 years ago when the pandemic started, you wouldn't see anything that's even relatively close to resembling that. If they kept running, momentum buyers would jump in and just, flood the market.
Wow.
And now the prices are moving up on very little trading. And it's like, how is this even possible? That's why I always talk about market manipulation, because it's like, if you go with the basic rule of thumb, for the price to move 100%, you have to trade the entire float. But
Right.
then you got to take into account what is the average volume daily for the last 60 to 90 days. And then, so you really just have to block that out because it's going to trade that no matter what. And then you have to start your 100%. And some of these, it to me it doesn't warrant it. But I still trade it because volatility is how we make our money.
I think you're right, man. I think it's gonna definitely come down, or continue to come down. That's good. Hey,
I still think that. Oh yeah, go ahead.
do you want to look at those tickers again and talk about those?
No, only because they're already headed south. So as of right now, none of them would be a buy. Except, I mean, Acer, that's a cheap one, and it's it's an IT, so it's going to eventually go up. So I
Yeah.
added more on the offering dip today.
So
But
did I.
I think nice. What
That's
we
good.
should do is see if we can get people to throw out tickers in the group, and then we can attack those as needed. We could jump on a quick 5-minute call. Both of us give our opinion on where we think it's headed, and then get off.
Well, right now?
Just whenever.
Yeah, that sounds good.
If only because those tickers on Monday, they're already shot. So
Yeah,
it's
those
like,
were.
okay, we're going to go ahead and.
You're right. Yeah.
Then
Okay, well,
everyone
sounds
be
good,
screaming
man.
at us.
Yeah, exactly. I know. I can't believe that video got destroyed.
It was such a good video too.
Oh my
Like we
God, we
did
talked
really
about
well.
good stuff.
Like
Man.
everything. I know.
I know. We really talked
Okay,
about good
yeah.
stuff.
So let's do that. If someone throws a ticker out, we'll get ahead and we'll get in touch with each other. Then we can jump on.
Yeah, we'll make a
We
video
could
about
do
it
that.
and all that stuff.
Right.
Yeah.
And
Okay.
hopefully it'll help people get used to, okay, even though we've been preaching what we look for, it's
Right.
really nice that they have a reference point to be able to go back to and be like, okay, I need to make sure I'm understanding what they're saying.
Exactly. Yeah. All right. Well, sounds good, man. I'm
Cool,
gonna
man.
close out this FOMC video, and if you want to keep talking, we can. But other than that, thanks for watching. If you have been watching this FOMC, man, it's really weird to me that they continue to continue to do the hike, but I don't know. I'm not the Federal Reserve, so right now I don't trust them. That's just, but I just don't want that trust to continue to not be there, because then
Right.
then we can, especially if other people start not trusting the Fed, then we should have bigger problems. But other than that, I think it's okay. Whatever. 25 BPS. Let's go. I was expecting the cuts, but whatever.
Yeah, I know.
Yeah.
Cool, man. All
All right, bro.
I will talk to you soon. Thank you.
All right. Peace out.